gold and silver prices are just going to keep going up. Why? Because the dollar is just going to keep going down. Powell just told you that, right? We're going to sacrifice the dollar. We don't care, right? We're cutting rates, even though inflation is above target. But more importantly, they're going to go to QE because what is going to happen? They're going to cut rates and long rates are going to go up. Then what? Because they want long rates to go down. That's the main goal. They want to get long-term interest rates down so the government, they think, can refinance the national debt at lower rates. They want to goose the housing market, right? Instead of doing the right thing by letting home prices go down, they want mortgage rates to go down so people can overpay for these homes.
Peter Schiff has consistently highlighted the fragility of the global financial system, and recent market developments appear to validate his perspective. Over the past year, foreign central banks have been steadily reducing their exposure to US dollars and treasuries, quietly reallocating reserves into gold. This trend reflects growing concern over the long-term stability of fiat currencies. The Federal Reserve's ongoing policies, including persistently low interest rates amid stubborn inflation, function as a catalyst for this shift. By signaling the potential for renewed money creation, the Fed has inadvertently emphasized the vulnerability of the dollar, making gold an increasingly attractive and stable alternative for both central banks and institutional investors. Despite these signals, retail investors remain largely disconnected from the evolving market dynamics. Many continue to sell gold and silver, misperceiving the current rally as overextended, while in reality, the metal's performance is only beginning to reflect the structural imbalances in global finance. Gold has surged approximately 28% year-to-date, surpassing even the gains of Bitcoin, which has risen about 21% over the same period. This divergence underscores a broader lack of awareness among individual investors, who are often guided more by short-term sentiment than by macroeconomic fundamentals or systemic risks. Perhaps the most striking manifestation of this shift lies in the performance of gold mining equities. The primary gold miner ETF, GDX, and the junior miners ETF, GDXJ, have both experienced gains approaching 80% in 2025, positioning the sector as the top-performing area of the market. Despite these extraordinary returns, mainstream financial media has largely overlooked this growth, focusing instead on cryptocurrencies, technology companies, and high-profile corporate stories. Schiff refers to this phenomenon as a stealth bull market, where significant value is quietly being generated away from the spotlight, offering informed investors a rare opportunity for outsized returns. Now, we present the clips from Peter Schiff's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Silver closed just below $39 an ounce. Gold was about maybe $33.70 or so not quite above $3,400. But the rotation that we've had, with foreign central banks out of dollars and out of treasuries into gold is going to accelerate as a result of this shift in Fed policy, right? Central banks are going to be more interested and more aggressive in their movement out of US dollars because the Fed has basically said, we are going to sacrifice the inflation side of the mandate because of the political pressure put on us by the Trump administration, which is still early days. We still got, 3.5 years left of Trump, and wait till Trump, gets complete control of the Fed. Wait till Powell is gone and some flunky has taken his place and they get some more FOMC members, right? He's going to completely have control of the Fed. And that means get rid of your dollars. That means buy gold. And again, it's not just central banks that should be doing that. Everybody should be doing that, right? Individuals should be doing that. They're not doing it yet. Again, I talk about the fact that at Schiff Gold, it's not like our phones are ringing off the hook. They should be, right? People should be calling in droves. We probably, we still get more people, I think, selling their gold and silver. They think they're getting a good price. They're getting a lousy price. Gold and silver prices are just going to keep going up. Why? Because the dollar is just going to keep going down. Powell just told you that, right? We're going to sacrifice the dollar. We don't care, right? We're cutting rates, even though inflation is above target. But more importantly, they're going to go to QE because what is going to happen? They're going to cut rates and long rates are going to go up. Then what? Because they want long rates to go down. That's the main goal. They want to get long-term interest rates down so the government, they think, can refinance the national debt at lower rates. They want to goose the housing market, right? Instead of doing the right thing by letting home prices go down, they want mortgage rates to go down so people can overpay for these homes. But when mortgage rates don't go down, then they're going to still want the Fed to bring them down. And how are they going to do that? Quantitative easing, where the Fed goes into the market and buys treasuries, or maybe starts buying the mortgage-backed securities again. They haven't been buying them at all. They've just been buying treasuries. In fact, they've been selling mortgage-backed securities as part of quantitative tightening. So obviously that's going to come to an end. I mean, that may come to an end in September. But there's going to be a lot of pressure on the Fed to resume quantitative easing in order to bring interest rates down. And that is going to bring the dollar way down. And you got to prepare for that. Look what happened to gold prices. Again, gold up. Gold is up 28% this year. It's a nice move, right? The year's not over yet. We're up 28% in the price of gold. Now, Bitcoin got all the headlines in 2025. That's all the financial community could talk about. Bitcoin is barely up. In fact, it's not even up 22%. Year to date. In fact, it was up 22% when I first started the podcast, but now it's dropped about $1,000. When I started doing this podcast about 40 minutes ago, and I looked at Bitcoin, it was 113,500, and it wasn't up 22% on the year. Now we're down 1,000. So Bitcoin isn't even up 21% now. It's at 112,500. So Bitcoin up 21% on the year. Gold up 28. Right? What I thought Bitcoin was supposed to be the fastest horse in the race, right? That's what who said that? That was Paul Tudor Jones, right? Oh, I'm buying Bitcoin. It's going to be the fastest horse in the race. Well, it's gold's got a nice lead this year on Bitcoin. In fact, I think they're sending Bitcoin back to the stable. In fact, eventually they're sending Bitcoin to the glue factory. Look at the gold and silver mining stocks. The GDX and the GDXJ were up 3.33% on the week. And the GDX and the GDXJ closed the week on new multi-year highs. I mean, maybe 12, 13-year highs. Year to date, the GDX is up 77.5%. And the GDXJ is up 78.5%. Those are huge returns. And, we're not even at the halfway mark for the third quarter. And we got those kind of returns. These gold stocks are on pace to more than double as a group in 2025. I said this when Donald Trump proclaimed that America was on the cusp or beginning, whatever, a new golden age. I said he means that literally. It's going to be a golden age for gold. And so far, gold is shining bright in the Trump presidency. But what's shining even brighter are the gold and silver mining stocks. So while everybody wanted to buy fool's gold and Bitcoin-related stocks, had they just bought gold stocks instead, they'd have made a lot more money. And in fact, even though gold and silver mining stocks are the best performing sector of the market, right? By far, there's not another sector that comes anywhere close, right? Precious metals mining stocks, hands down, the best performing group in the U.S. Why do they get no coverage? Turn on CNBC, turn on Fox Business. They don't talk about these stocks. I mean, maybe you get to Fast Money on CNBC and somebody will say, yeah, I like Barrick Gold. I like the GDX. Okay. Yeah. Someone will mention that like as a pick, but they really don't focus on it. Instead, they spend so much coverage on Bitcoin, right? And MicroStrategy.
Peter Schiff has been vocal in his criticism of the Federal Reserve's inflation averaging policy, a strategy introduced by Jerome Powell that allowed inflation to temporarily exceed the 2% target to offset years of below-target levels. While the Fed presented this approach as a careful, academic framework aimed at stabilizing long-term prices, Schiff insists it was fundamentally misguided and detached from real-world impacts. In practice, rising prices affect consumers and businesses immediately, and no one benefits from higher inflation to balance a statistical calculation. Schiff argues that this policy was more of a theoretical justification than a practical solution, highlighting the gap between central bank models and everyday economic realities. He further points out that inflation averaging gave the Fed an excuse to keep interest rates lower for longer, even as inflation persisted. By focusing on an average target rather than current economic conditions, the Fed delayed necessary rate hikes, effectively extending its accommodative monetary stance. Schiff contends that this approach distorts market signals and creates a misleading sense of security, while ordinary households and businesses bear the real costs of rising prices. He warns that such a disconnect leaves the economy more exposed to shocks that could have been managed with timely and appropriate policy measures. Here's Peter's perspective on the issue.
Everything that all our money under management is going way up. And again, I mentioned, we had record withdrawals last year, especially in the fourth quarter. I feel bad for the customers who threw in the towel last year, especially in Q1, right? Because they just missed this huge gain. But you know what? They should come back. If you're watching this podcast video and you pulled your money out last year, all right, you made a mistake. It's an even bigger mistake not to send it back, because I think the gains that you will miss out on will dwarf the gains you've already missed out on. Right. So you got to get out of US dollars. You got to get out of overpriced US stocks, and you got to get into these foreign stocks. Now, the first movement is going to come from abroad, right? The first thing is, Europeans and Asians sell their US stocks, right? Because they see the losses, because they see the FX. They measure their US stocks in their own currencies. So measured in euros, you got a flat to down US stock market this year. So the Europeans are losing money in U.S. stocks. Well, but their markets are doing great. So people are going to be pulling their money out, especially with the tariffs. The tariffs are alienating us from the rest of the world. The tariffs are bringing our enemies closer together, right? If these are our enemies. But the tariffs are bringing China and India and Russia closer together, strengthening their trading relationships. China, meanwhile, is building up its relationships in Africa, building up its relationships in South America, even in Canada. Right? So we're actually improving China's trade relations with the rest of the world by trying to isolate them from the U.S. or jack up these tariffs. And we're doing the same thing with India. So all this stuff is going to backfire. And so all this is bad for the U.S. stock market. Meanwhile, look at Trump bragging about the U.S. government strong-arming Intel into giving up a 10% stake to the U.S. government, right? So the U.S. government, and Donald Trump is bragging about this, that the U.S. government didn't pay any money, and Intel just gave the U.S. government, gave it for free, 10% stake in the company. Now, why do you think Intel did that? I mean, did they just give the government 10% of their company? Of course not. We don't know what went on behind the scenes. We don't know what kind of pressure or extortion. Like, what did Trump say to Intel? Like, hey, this is what you need to do, or this is what we're going to do, or we'll do this, but only if you do this. Obviously, there was some kind of quid pro quo here. Intel didn't just give the U.S. government 10% of its business, right, for nothing, right? Then the government's going to do this to you. So if you want to prevent us from doing this, you got to give us 10%. That's like a shakedown. That's like the mafia, right? My dad called the U.S. government the federal mafia. He was just talking about the IRS, but now I guess the whole government, right, is protection money. We are going to do this to you unless you give us a 10% stake, because now that the U.S. government owns 10% of Intel, well, we're not going to screw our own company because we're a big shareholder. In fact, the U.S. government is now the biggest shareholder in Intel. Who thinks that's a good idea? Certainly not me. I don't think the U.S. government should be buying into any private companies, because obviously, isn't the government going to favor companies that it has a stake in? Of course. So how is that capitalism if the government picks winners, but they usually pick losers when they try to pick winners? But now the government wants to tilt the playing field in favor of Intel and against its competitors that it doesn't have a stake in. So this is bad. This is unconstitutional. There's nothing in the Constitution that authorizes the U.S. government to take stakes in private companies, right? And of course, this is the slippery slope to communism, because if you allow the government to buy into companies, and in this case, they didn't even buy their way in, they extorted their way in. But, the government, if they control the printing presses, they could just print up money and buy everything. They could basically nationalize the means of production by buying everything with the money they print, right? They could effectively nationalize the whole economy and become a communist country. This is not capitalism when the government buys into companies or shakes them down and demands a piece of their action, right? And it's not like legitimate taxation. Congress didn't authorize this, right? This is like a wealth tax. This is like the government taxed Intel and said, we want 10% of your company as like a tax, so turn it over to the king. And they did. And the Republicans love it. I guarantee you, if Joe Biden did this, the exact same thing, there would not be a Republican in Congress who would be on board with it.
What becomes impossible to ignore is that policy credibility is unraveling right before our eyes, and this trend could define the financial landscape for years to come. Central banks abroad are sending a quiet but unmistakable signal. Their confidence in the dollar is fading, and their moves suggest a long-term pivot toward alternative assets that hold tangible value. Meanwhile, domestic investors are often distracted by headlines that highlight tech stocks and cryptocurrencies, missing the more profound signals coming from sectors like mining, which are quietly demonstrating remarkable strength. As traditional metrics and narratives are manipulated to maintain an illusion of stability, the divergence between perceived control and actual fragility continues to widen, setting the stage for a potential seismic shift in global finance. Looking ahead, the erosion of trust in conventional monetary systems could lead to a repricing of both currencies and assets, with far-reaching consequences. If confidence diminishes gradually, markets may experience a prolonged period of instability, characterized by incremental losses and increasing volatility. Conversely, if the illusion of monetary discipline shatters suddenly, the resulting shock could be abrupt and intense, catching both retail and institutional investors off guard. In such a scenario, assets that are universally recognized and immune to arbitrary policy manipulation, such as gold, silver, and other tangible stores of value, could surge in importance as investors scramble for security amid uncertainty. How do you anticipate the price trends of gold and silver evolving in the near term? Share your thoughts in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.